Something just snapped in the global silver market, and almost no one is talking about it the way they should be. Shanghai silver just printed $78.49, a price that was never supposed to exist in a synchronized global system. Not because silver can't be worth that much, but because if markets were functioning normally, that price would have been erased instantly. Arbitrage would have rushed in, supply would have moved, and the gap would have closed. Instead, the gap is growing. And now analysts are whispering about a potential $20 arbitrage gap forming between East and West. That is not bullish enthusiasm. That is panic beneath the surface. Because when arbitrage stops working, it means metal is no longer flowing, banks can no longer balance exposure, and price is no longer being discovered honestly. This is not a rally. This is a warning. Welcome to Boring Silver Mystery, the channel where quiet numbers expose loud failures. Today's video is not about price targets or speculation. It's about mechanics. Global commodity markets survive on one assumption, that price differences are temporary and self-correcting. When that assumption fails, the system underneath is already breaking. Shanghai hitting $78.49 while Western prices lag far behind tells us that physical silver and paper silver are now operating in two different realities. In this video, we will walk through why this happened, why the arbitrage gap matters more than the price itself, and why this moment could mark the beginning of a disorderly repricing that banks cannot control. A silver price of $78.49 in Shanghai is not shocking because it is high. It is shocking because it exists alongside much lower prices elsewhere. In a healthy market, global silver prices remain tightly connected. Any deviation is quickly corrected by arbitrage. The fact that Shanghai can sustain such a premium tells us that physical silver is being valued independently of paper markets. Shanghai's pricing structure is far more connected to delivery and real demand. When buyers there pay higher prices, it reflects urgency, scarcity, and competition for actual metal. This is not speculative enthusiasm. It is a signal that physical supply is constrained. The number itself matters less than what it represents. A market that is no longer synchronized with the rest of the world. Arbitrage is the mechanism that keeps markets calm. When silver trades higher in one region, traders are supposed to buy it where it's cheaper and sell it where it's more expensive. This movement of supply equalizes prices and restores confidence. But arbitrage only works if physical silver can actually move. It requires available inventory, functioning logistics, and confidence in delivery. When any one of those breaks, arbitrage doesn't just slow down, it stops. The Shanghai premium tells us that arbitrage is not failing because traders are asleep, but because the metal is not accessible. That is when price gaps stop being opportunities and start being warnings. The most alarming part of this situation is not the existence of a gap, but its direction. Instead of narrowing, the gap is threatening to widen. This suggests that attempts to source silver for arbitrage are failing. Either inventories are unavailable, delivery timelines are stretched beyond usefulness, or metal is already committed to industrial buyers. A widening gap tells us the system is under stress. It means the price in Shanghai is not being pulled down, and the price elsewhere is not being allowed to rise. That tension builds pressure. Pressure in commodity markets never releases gently. Bullion banks depend on arbitrage as a safety valve. It allows them to hedge positions, manage risk, and keep prices orderly. When arbitrage fails, those positions become dangerous. If Shanghai prices continue to reflect physical scarcity, while Western paper markets remain artificially subdued, banks find themselves short metal they cannot source. This is how institutions become trapped. Not by sudden crashes, but by slow erosion of flexibility. The longer this divergence lasts, the harder it becomes for banks to regain control. Shanghai is not pricing hope, it is pricing necessity. Buyers there are willing to pay higher prices because they need silver now, not later. This reflects industrial demand, strategic stockpiling, and physical scarcity. Unlike Western futures markets where contracts can be rolled endlessly, Shanghai forces confrontation with reality. If metal is scarce, price rises. That is why Shanghai often leads during periods of stress. It is not predicting the future, it is reacting to the present. Western silver prices lag because they are cushioned by paper volume. Futures markets allow participants to settle in cash, roll contracts forward, and delay confrontation with physical limits. This creates the illusion of stability. But illusions cannot last forever. Paper markets can suppress signals, but they cannot manufacture metal. When physical demand overwhelms paper defenses, price adjustments become sudden and violent. Shanghai's price is a glimpse of where reality is heading. True price discovery requires honest supply and honest settlement. When those disappear, price becomes fictional. The growing gap between Shanghai and Western prices suggests that silver is now being priced in two systems at once. One system reflects real metal and immediate need. The other reflects leverage and deferred promises. History shows that when markets split this way, the physical market eventually dominates. Paper pricing survives only as long as confidence remains untested. China's demand for silver is not speculative. It is structural. Silver is essential for solar panels, electronics, electric vehicles, and advanced manufacturing. These industries cannot pause because prices are volatile. When supply tightens, price must rise to ration usage. Shanghai reflects this industrial urgency. This demand removes silver from the market permanently, embedding it into infrastructure rather than storing it in vaults. That makes shortages harder to resolve and gaps harder to close. A $20 arbitrage gap would represent a breakdown in global pricing integrity. At that point, markets would no longer be connected by supply flows. Such a gap would force a resolution. Either Western prices would surge to reconnect with physical reality, or paper markets would fracture under delivery stress. Both outcomes would be destabilizing. The longer the system resists adjustment, the more violent the eventual correction becomes. This is not retail enthusiasm, social media hype, or speculative mania. This is a structural event driven by physical scarcity, geopolitical fragmentation, and industrial necessity. Shanghai did not cause the problem. It revealed it. The silver market is not overheating. It is being forced to confront limits it has ignored for years. That is why this moment feels different, because it is. Shanghai hitting $78.49 is not a forecast. It is a signal that arbitrage is breaking, that physical silver is scarce, and that the paper market's grip on pricing is weakening. When price gaps stop closing, control is already slipping. Markets do not fail when everyone is panicking. They fail when everyone assumes the system will fix itself. And right now, the system is running out of room. If you're still watching, you're already ahead of the headlines. Boring silver mystery exists to uncover the quiet signals that matter before they become impossible to ignore. If this analysis helped you understand what's really happening in the silver market, subscribe to the channel, like the video, and share your thoughts below. Because the most important market events don't announce themselves. They reveal themselves slowly, and then all at once. This is boring silver mystery where boring numbers expose broken systems.